So, what is an index is our first question. Index is a statistical indicator. In financial markets, an index is a portfolio of securities that represent a particular market or a portion of a market. Each index has its own calculation methodology and usually is expressed in terms of a change from a base value. The base value might be as recent as the previous day or many years in the past. Thus, the percentage change is more important than the actual numeric value. Financial indices are created to measure price movement of stock, bonds, T-bills and other type of financial securities. It is also created to provide market participants with the information regarding average share price movement in the stock or in the stock market. Now, let us know what is the significance of stock index. Firstly, it is an indicator of the performance of overall market or a particular sector. Then, it serves as a benchmark for portfolio performance. It is used as an underlying of financial application of derivatives. Attributes of an index. It should reflect the market behavior. It should be computed by independent third party and be free from influence of any market participant. It should be professionally maintained. Next we have are the types of stock market indices. First we have is market capitalization weighted index. Next, free float market capitalization index. Then we have is the price weighted index. Then equal weighted index. So let us know about them in detail. Firstly, we have is market capitalization weighted index. Under this method of calculation, each stock is given weight according to its market capitalization. So higher the market capitalization of a security, higher is its weight in the index. Market capitalization is the market value of a company calculated by multiplying the total number of shares outstanding to its current market price. Let us go through an example over here. So now we have a ABC company with 5 crore shares outstanding at a share price of rupees 120 per share. So now let us calculate the market capitalization for this company. So we have to multiply the number of shares into the price value of the share to know the market capitalization of the company. So here the company has 5 crore shares which are outstanding, which is multiplied by the share price or the per share price, that is 120 rupees. That will give us rupees 600 crores, which is the market capitalization of this company. Now let us move on to another example. In example 2, there are 3 stocks in an index. Base value of the index is set to 1 as on January 1995. We have to calculate the present value of index based on the following information. So we have got 3 stocks named A, B and C. And the stock price on 1st January 95 for A was 150, for B it was 100 and for C it was 250. Number of shares which were outstanding in the market were 20, 30 and 8. Now, today's stock price for the company ABC is 650, 350 and 500 respectively. So firstly, we need to calculate the market capitalization for the year 95. That is, on 1st January 95, we should know what is the market capitalization for the company. So here we have the stock names, the stock prices on 1st Jan, number of shares which were there in the market. Now, if we have to know the old market cap of the company, we have to multiply the number of shares, that is this, into the price of the share. which will give us 3000 in the case of A, 3000 in the case of B, and 2000 in the case of C. So the old weightage would be the old market cap divided by the total of old market cap. So the old market cap over here is 3000 in case of A, and the total is 8000. So our old weightage would be 0.375% in the case of A. In the case of B, it's 0.375, and in the case of C, it's 0.25. Now, the old value of portfolio is calculated by multiplying price into the weightage. So, the price for A is 150, for B is 100, and for C is 250. We have to multiply this with the weightage, the old weightage. That will give us 1125 for A, 1125 for B, and 500 for C. This is the total of old value of the portfolio. Now, we have to calculate the new market capitalization. So, our new price is given to us, that is 650 for A, 350 for B, and 500 for C. We have to similarly take out the new market cap over here by multiplying the number of shares into the new price. That will give us 13,000 for A, 10,500 for B, and 4,000 for C. Then we have to take out the total for all three. Now, this is the total new market cap which is available according to today's market. Now, to take out the new weightage, we have to divide the new market cap with the total of the new market cap. That will give us 0.47 in case of A, 0.38 in the case of B, and 0.15 in the case of C. So, the new value would be the new price into the weightage, that is 6,110 in case of A, 3,990 in the case of B, and 600 in the case of C. When we add the new values of A, B, and C, we get 10,700 as the new value in today's market. Now, if we have to calculate the present value of index under market capitalization weighted method, we have to divide the new value by the old value, and then we have to multiply that by 100 to get a percentage. So it is 389.09. This is the answer for us. Okay, this is not clear, so let me erase. Yeah, so now it's clear for us. Now, here we can see that this is our new market capitalization weighted value. Next we have is free float market capitalization index. Equity holding is divided differently among various stakeholders, promoters, institutions, corporates, individuals, etc. Market has started to segregate this on the basis of what is readily available for trading and what is not. So, the one available for immediate trading is categorized as free float. If index is computed based on weights of each security based on free float market cap, it is called free float market capitalization index. Both Sensex and Nifty over a period of time have become a free float. Next we have is price weighted index. It is an index in which each stock influences the index in proportion to its price. Stocks with a higher price will give more weightage than the lower one. The stocks with higher price has a greater influence over the performance of the index. Dow Jones Industrial Average and Nikkei 225 are popular price weighted indices. Now, let us go through an example. Here also we have got three stocks A, B and C for which the prices are given as on 1st January 95. Now the base value of index is 1. We have to calculate the present value of index from the table using price weighted index. and the number of shares which are available in the market are 20 for A, 30 for B and 8 for C. And today's market price is 650, 350 and 500. So, let us compute for the answer. Over here, we know stocks A, B and C and the old prices as on 1st January 95 are given. We have to now calculate the price weights, that is the old price weights. So that will be calculated by dividing the old stock price by the total of old stock prices. So over here the total of old stock prices is 500. We have to divide 150 by 500 to get 0.3, 100 by 500 to get 0.2 and 250 by 500 to get 0.5. Now, price weighted prices, that is price weights into the stock. So, over here we have price weights as 0.3 and the stock, the number of stock that is available or the stock price that is there is 150. We have to multiply the price weights and the stock prices. That will give us 45 for A, 20 for B and 125 for C. When we total all three, it will give us 190 rupees. The new prices are given to us as 650, 350 and 500 for ABC respectively. Now, the new price weights would be the new prices divided by the total of the new prices. That will give us 0.44 for first one, 0.23 for second and 0.33 for the last one. So the new price weighted prices are 286, 80.5 and 165. So the new price weighted prices are calculated by the new price weights into the stock prices or into the new stock prices. That will total up to rupees 531.5. So, the present value of index and the price weighted index would be the new price weight divided by the old one into 100, that is 279.74. Equal weighted index. This index does not make any distinction between large and small companies. Both are given equal weightage. The value of the index is generated by adding the prices of each stock in the index and then dividing the above product by the total number of stocks. So we have an example over here. We have company ABC again with the same prices and the same number of stocks that are available in the market. Then we have the new prices for ABC respectively. Now, the base level of the index would be the total of 150, 100 and 250, that is 166.67. And the current level of index would be the addition of the new prices, that is the today's prices, that is 650, 350 and 500, which when divided by 3 will give us 500. So, the present value of index on equal weighted index would be the new or the current level of the index divided by the old one into 100, which will give us 299.99. Okay, I'm sorry. That will give us 299.99 or 300.